The global aviation industry is experiencing a period of remarkable growth and prosperity, driven by a combination of rising passenger demand, increased airline profitability, and expanding aircraft fleets across the world. As economies recover, pent-up travel demand is unleashing waves of new customers eager to explore both domestic and international destinations. Emerging markets are also seeing a surge in travel, with countries in Asia and the Middle East in particular increasing their share of global air travel. This rise in demand is fueling substantial order backlogs for the global duopoly of Airbus and Boeing, as well as stimulating interest in innovative aircraft designs focused on fuel efficiency and sustainability. Later in this presentation, I'll pinpoint my favorite investment play on the multi-year megatrend of global aviation growth, and it's neither Airbus nor Boeing. Some of the most advanced innovations are occurring in avionics technology. Airlines are increasingly investing in fleet modernization to meet stricter environmental regulations and reduce fuel costs, creating a further boon for aerospace companies. New aircraft models like Airbus's A321XLR and Boeing's 777X are being developed to offer longer range and greater efficiency, aligning with airline strategies to meet evolving passenger needs while cutting operational costs. However, Boeing continues to face notable challenges despite these tailwinds in the aviation sector. Let's take a closer look at global aviation trends from now and 10 years into the future. The latest forecast from the International Air Transport Association, the IATA, estimates that industry revenues will reach an all-time high of nearly $1 trillion this year. Nearly 5 billion passengers are projected for 2024, surpassing the 2019 count by over 400 million. According to Precedence Research, the global aerospace market size accounted for $373.61 billion in 2024, will grow to $402.75 billion in 2025, and is projected to surpass $791.78 billion by 2034, representing a robust compound annual growth rate, CAGR, of 7.8% between 2024 and 2034. The report's key takeaways. North America contributed more than 46% of revenue share in 2023. The Asia-Pacific region is estimated to expand the fastest CAGR between 2024 and 2034. By size, the narrow-body segment generated 78.2% of revenue share in 2023. By size, the wide-body segment is expected to expand at the fastest CAGR over the projected period. These trends are generating tailwinds for aircraft manufacturing. The new Aviation Week commercial fleet and MRO forecast is considered the gold standard of aviation forecasts. See the following chart. According to the 2025 version of the annual report, released to the public in late October, more than 21,900 new commercial aircraft deliveries will occur worldwide over the 10-year 2025-2034 forecast period. Narrow-body types are projected to lead this growth, with the Airbus A320neo family outpacing the Boeing 737 MAX family. Among all the new aircraft that are expected to be delivered between 2025 and 2034, 70% will be from the neo and MAX aircraft families. The Airbus-Boeing duopoly will account for 91% of aircraft deliveries globally over the forecast period. The forecast reveals a 3.1% CAGR fleet growth during the period, with 44,600 aircraft in service by 2033. We're witnessing a significant shift, with Airbus increasingly pulling ahead of Boeing. This trend is expected to continue in 2025 and beyond, boosting the base values and lease rates of Airbus aircraft, but weighing on those for Boeing aircraft. From product development setbacks and safety concerns to a changing competitive landscape, Boeing's troubles have allowed Airbus to consolidate its lead. Boeing's recent leadership changes, including the potential impact of CEO Kelly Ortberg, offer hope for a fresh strategic direction that could help address its issues. However, the problems at Boeing run deep, and Ortberg so far hasn't implemented the radical cultural change needed to turn around the beleaguered company. The new year will prove pivotal for Boeing. That said, Boeing's arch-rival Airbus faces challenges of its own. Airbus is grappling with supply chain bottlenecks, and it has miscalculated in the introduction of some new aircraft models that were expensive to produce, but which failed to meet expected demand. Smaller aircraft makers, such as Brazil-based Embraer, are challenging the Airbus-Boeing duopoly with innovative, more fuel-efficient designs, especially in the business VIP aircraft segment. That's why my favorite play on the aviation trends I've just described is the simplest, safest way to profit: the U.S. Global Jets Exchange Traded Fund. With net assets of more than $1 billion, the Jets ETF is focused on airlines, aircraft manufacturers, and other key players in the aviation ecosystem, making it well-positioned to benefit from a multi-year growth trajectory in global commercial aviation. Jets primarily invests in major airlines, including U.S. and international carriers, aircraft manufacturers, and companies in related sectors like airport services and aircraft leasing. The following chart shows the ETF's top 25 holdings. This broad exposure allows investors to capture growth across the entire aviation chain, from travel demand to aircraft production. The Jets ETF includes airline stocks with exposure to hedging strategies, which can help stabilize performance despite fluctuations in fuel costs. Commercial aviation is a cyclical yet resilient industry. Over the long term, demand for air travel tends to grow alongside GDP and global wealth, making Jets a potential long-term portfolio stabilizer. Jets has racked up a year-to-date total return of about 27% and a one-year total return of 53.8%. The expense ratio is a reasonable 0.60%. For investors seeking a straightforward way to capitalize on these tailwinds, the Jets ETF offers diversified exposure to the aviation megatrend. Well, that's it for now. Thanks for watching. And if you have any questions or comments, please don't hesitate to send an email to me at mailbag@investingdaily.com. Thanks so much for watching. If you like this video, hit the like button, leave a comment, share the video with colleagues and friends, and if you haven't already, subscribe to my YouTube channel.